Welcome back to the Digital Asset Report. Bitcoin traded as high as 76,000 and Ethereum reached 2,400 midweek as digital assets moved to quarterly highs after a giant reversal in global markets took SPX to new all-time highs. Treasury Secretary Scott Bessent said he expects U.S. gasoline prices to move back into the $3 range this summer, sooner rather than later, a reminder that energy and inflation are still part of the crypto story right now. Take a listen.
I'm optimistic that sometime between June 20th and September 20th that we can have $3 gas again. And as I said this morning too, we are going to be watching the gas stations because they raise prices very quickly. When the crude oil prices went up, we hope they'll bring them down just as quickly as crude oil prices have come down, which they've come down substantially just in the past 10 days.
The biggest story this week is Wall Street moving to increase crypto access. Charles Schwab said it will begin a phased rollout of spot crypto trading in the coming weeks, starting with Bitcoin and Ethereum. 2 days earlier, Goldman Sachs filed for its first Bitcoin ETF product designed to give investors Bitcoin exposure plus income from options. Goldman's move comes right after Morgan Stanley launched its own Bitcoin fund last week. The message is hard to miss here. The largest financial firms are no longer treating crypto as an edge case. They're building products, fee strategies, and distribution around it. Also this week, Deutsche Boerse said it bought a $200 million stake in Kraken, deepening a partnership focused on regulated crypto, tokenized markets, derivatives, and institutional liquidity. This is not just banks offering wrappers. This is traditional exchange infrastructure moving directly into digital asset plumbing. Stablecoins also remain central this week. Circle CEO Jeremy Allaire said in Hong Kong that stablecoins are becoming part of global trade and finance. And Reuters reported that USDC circulation grew 72% year over year to $75 billion by the end of 2025. RBC analysts added that corporate payments is one of the clearest near-term use cases, with major banks exposed if treasury and payment flows move on to crypto rails. On the regulatory front, the UK Financial Conduct Authority opened a consultation on April 15th covering crypto trading platforms, custody, safeguarding, and staking, with rules due by October 2027. And in the US, the SEC issued staff guidance on April 13th about certain self-custodial interfaces for crypto asset securities. The agency said some of these interfaces may operate without broker-dealer registration, but that they must stay within the strict limits and disclosure requirements. Meanwhile, CFTC Chairman Michael Selig told Congress he plans to keep pushing forward on digital asset rulemaking. And in other news, Michael Saylor appeared on the Bankless podcast this week and pushed back again on one of the market's biggest worries about strategy. Saylor said there is no margin in the capital structure and argued that the company's equity and preferred structures do not create the kind of short-notice collateral calls that force liquidation. Saylor emphasized that the effective duration of preferred stock instruments like STRC works out to about 20 years.
But aren't you as well putting some margin in the company itself or in the structure itself? And can't you get bitten by the volatility across those years and decades?
There is no margin in the capital structure. Let me make a point. Margin loans are when I borrow against an underlying asset with the obligation to meet a collateral call on 1 or 2 days' notice. So margin debt is 1 day money. When we sell STRC, we're selling equity. It's the exact opposite. If you give me $1 million for my equity, for common equity, I have the money forever with no obligations. Okay, that's the longest duration money. When you give me $1 million to buy a preferred equity with a variable dividend, if you read the securities document and you understand what that security is, you're entering into a perpetual swap. It's not like you can go to the bank and say, give me the $1 million back tomorrow. In fact, you're not getting the money back ever, right? It's an equity investment. If you wish to sell the instrument, you can sell it into the market, but you're selling it to other investors. And so the magic of this structure is you're creating a perpetual swap that's got stochastically, if you were to actually do the statistical modeling, it's more like a 20-year duration instrument. So the issuer has the money for about 20 years, but Bitcoin could fall 95%. It doesn't create there is no liquidation. It doesn't come due in 5 years. It doesn't come due ever, right? And so this is the ideal kind of credit instrument for a volatile environment. The company is paying a dividend to stabilize it But in the event that the credit of the company improves, if there's too much demand, the company can reduce the dividend rate in order to decrease the demand.
The pattern this week is clear. Prices are still fragile and macro still drives the day-to-day tape, but underneath that, the industry keeps getting stronger. Brokers are adding spot access, large banks are launching differentiated ETF products, and exchanges are buying into crypto infrastructure. Regulators are filling in the map, and the biggest treasury players are emphasizing the durability of their capital structures. The market may still be cautious, but the build-out is accelerating. That's it for today. If you enjoyed this video, be sure to give us a like and follow along for more.